What's going on, guys? It's John Dion here, and today I want to talk to you about the new Morrison government's first home loan deposit scheme coming out on the 1st of January 2020. Specifically, who is eligible, what price caps have been implemented for the different states, and how to apply for the scheme. This scheme has been born out of the success of a similar scheme implemented in New Zealand in 2013. And has been modelled to allow eligible first home buyers to apply for a 95% LVR loan without having to pay lenders' mortgage insurance. If you're not sure what LVR stands for, it just means loan to value ratio, where in this case you only need a 5% deposit. So for a $500,000 house, you would only need $25,000 as a deposit and borrow the remaining $475,000 as a loan, meaning you're borrowing 95% as a loan compared to the value of a $500,000 house. This would usually result in you paying lenders' mortgage insurance, also known as LMI, because it's much riskier for the banks to loan out a high LVR. Usually loans greater than 80% trigger lenders' mortgage insurance. Essentially, this is the banks getting you to pay for their reassurance. Because if you had to sell the property due to unforeseen circumstances in a low property market, with an 80% LVR, they have 20% buffer of the property price to ensure that the loan gets paid out in full once it's been sold. On a $500,000 house, a 20% deposit is $100,000. So even if you had to sell at a quick sale of $450,000, meaning you actually lost money on the property, which does happen, the banks will take $400,000 first to pay off their loan. And then you're left with a measly $50,000, which will most likely be eaten up by agent sales fees and legal costs. So this lender's mortgage insurance isn't for you, it's for the banks, and it's a one-off payment that can go towards your total loan amount, which means that you have to pay interest on it if you choose to do so, which of course is a win-win scenario for the banks. Continuing on with our $500,000 house example, if you did have to pay lender's mortgage insurance on a 95% LVR loan, it would come to $15,722. Not having to pay this is another huge financial saving, and the scheme allows for this as the government will underwrite your home loan and serve as a guarantor. Although saving for a deposit isn't the biggest issue for first home buyers, it's actually the serviceability requirements from the banks. In my personal view, this is a much better scheme than the previous ones, as at the foresight, having to pay a 20% deposit is a lot of money, and some would deem it impossible before they even got started saving. The biggest gripe Australia has with this scheme is that it will only support 10,000 loans, and given 110,000 first homes were purchased in 2018, this is only something like 9% of that total first home buyer market. However, there is a little secret that most haven't picked up on yet, and you can take full advantage of it if you get in early. All you have to do is make that little like button turn blue. But also, if you just love my content and you want to support the channel, make sure you smash that like button as it seriously helps out with the YouTube algorithm. In a joint media release with Michael Sucker serving as the Minister for Housing, the scheme will support 10,000 loans each financial year. So there will be that initial 10,000 loans when the scheme is kicked off in January 2020, but also another 10,000 loans will open up again in the next financial year, starting July 2020. So if you feel like you're going to miss out because of those limited numbers, or you're not in the right financial position right now, or you haven't saved a big enough deposit, you could aim to apply for the scheme in July 2020. But in the meantime, let's make sure you are eligible to apply. There are 4 main tests that you will have to pass to be deemed eligible, including an income test, a prior property ownership test, a citizenship test, and a minimum age test. On top of that, you also have a deposit requirement and an owner-occupier requirement. The income test comes in 2 main formats, one for both singles and one for couples applying together. For singles, your taxable income for the previous financial year must not be more than $125,000. And for couples, combined your income must not be more than $200,000. Your lender, also known as your bank, will be the ones to assess your income test. And for the January 2020 10,000 intake, they'll be looking at your 2018 to 2019 financial year to assess your income. And for the July 2020 intake, they'll be looking at the 2019 to 2020 financial year. The prior ownership test is to ensure that only genuine first home buyers are applying, and it requires you to not have ever owned property in Australia, an interest in a lease of land in Australia with a term of 50 years or more, or a company title interest in land in Australia. These tests are applicable for properties in all states and territories of Australia, regardless of whether the property was a commercial, investment, or owner-occupied property, irrespective of whether it was lived in or not. They also apply if any of the properties listed previously had been held by you on your own or together with someone else. For example, if you held a property with a former spouse or de facto partner, as a couple, you are not eligible first home buyers. Unfortunately, the scheme is only open to current Australian citizens, and the citizenship test ensures that you are an Australian citizen. The minimum age test requires you to be 18 years of age or over. Both tests are confirmed at the time you enter into a home loan with your participating lender. The scheme is set up to assist singles and couples who have at least 5% of the value of an eligible property saved as a deposit. If you have 20% or more saved, then your home loan will not be covered by the scheme. So if you're waiting to save a bit more money, it may actually make the scheme unachievable for you. Investment properties are not being supported by the scheme, so this is why they have put in place that owner-occupier requirement, which essentially means that you need to move into the property within 6 months of the date of settlement, or if later, the date an occupancy certificate is issued, and continue to live in that property for so long as that home loan is guaranteed under the scheme. If you don't live in your property, including where you move out of the property at a later time, your home loan will cease to be guaranteed by the scheme. In these circumstances, there may be certain terms and conditions of your home loan that requires you to take certain actions. You may need to pay fees and charges and/or take out insurance that would not have otherwise applied if your home loan were participating under the scheme. Your lender or your bank will be able to explain these specific requirements to you, so make sure you ask before applying. There is also a list of requirements for the types of properties that are eligible for the scheme. There's nothing particularly out of the ordinary here. The list is only there to bound the legal requirements for the various types of purchases, such as an existing dwelling, a house and land package, building your own home, and an off-the-plan purchase. Same again for the types of loans that are eligible for the scheme, except this time the list of requirements has some worthy statements to note. 100% of the money that you borrow must go towards the property. You can't spend it on a car or a holiday. And the loan term can't be longer than 30 years. These days, some loans can be dragged out to even 40 years. In addition, you must make regular principal and interest loan repayments, which means that you can't get an interest-only loan. And there must not be any changes to the loan terms, such as an increased limit. This means you may face some issues down the line when trying to pull out some equity, and you may lose the scheme as a guarantor if you choose to do so. These two statements are my biggest issue with the scheme, as using an offset account with an interest-only loan and withdrawing equity after a couple of years of growth is a key move for purchasing a second property. But hopefully after a few years, you'll be in a much better position and not have to have the government as a guarantor. The scheme has set price thresholds to ensure that you don't take full advantage and buy a $2 million home with the government as a guarantor. These are broken down into capital cities, large regional centres and regional areas. For Victoria, it's a $600,000 cap for the capital city and regional centres, with a $375,000 cap on the rest of the state. In New South Wales, the capital city and regional centre cap is $700,000 and $450,000 for the rest of the state. The remaining state caps can be seen in this table. If you're unsure if the area you're planning to buy in sits under a regional centre or the rest of the state, a regional centre is defined as a city with a population above $250,000, such as Newcastle, Wollongong or Geelong. The scheme won't be open until the 1st of January 2020, and once commenced, applications will need to be lodged through participating lenders, which in total there are 27 of. I'll leave a link in the description section below of the full list of lenders. However, only 2 of the major banks, being the National Australia Bank, also known as NAB, and the Commonwealth Bank of Australia, will offer guaranteed loans from the 1st of January. The remaining 25 non-major lenders will begin offering guaranteed loans from the 1st of February. I personally do think the scheme is a great way to get your foot in the door of the property ladder. However, if you feel like you're being constrained by the price caps or by the limited lenders available for the scheme, don't hinder your future financial performance by buying a lower quality asset just because it fits under that price cap. If you can afford to purchase a better quality property that's going to perform more consistently over time without the use of the first home loan deposit scheme, don't be bound and limited to the constraints that the government have come up with to help out the affordability of housing, just so you can be a little bit more leveraged and avoid lenders' mortgage insurance. It's all well and good to leverage yourself ahead with this scheme to get yourself into the property ladder. But as as discussed earlier, you can actually lose money in property. So make sure that you educate yourself on what makes a good area to buy in and the types of properties that perform better over time, which I've done a whole nother YouTube series on. If you're watching this in the future, have you already applied for a first home loan deposit scheme, or are you planning to in the near future? I want to know what the process is like. Leave it down in the comment section below. As always, seek your own professional financial, legal and property investing advice for your current situation. These videos are just my opinion and are general in nature and should never be considered as personal advice. If you're keen for more content, make sure you subscribe and hit the notification button so you don't miss a video. And until next time, happy house hunting.